What if you could collect $1,000 in passive income every single month from dividends? Imagine covering a big chunk of your bills without ever lifting a finger. Today, we're revealing the fastest way to reach $1,000 per month in dividends, and it's totally achievable, even if you're of average means. But here's the challenge. Getting $1,000 a month in dividends isn't magic. It usually requires either a lot of money invested or a lot of time. And most people making between $40,000 and $80,000 a year don't have huge portfolios just lying around. Huge dividend stocks can pay more now, but might be riskier, while safer dividend stocks grow slowly. So how do you speed this up without taking crazy risks? In this video, we'll break down two paths to that $1,000 a month goal. One that chases high yield stocks for quicker income, and another that relies on conservative dividend growers for stable long-term income. You'll see real examples of US dividend stocks and ETFs, exactly how much you'd need to invest and how long it might take if you put aside as little as $100 to $500 a month. By the end, you'll have a clear game plan for the fastest route to $1,000 in monthly dividends tailored for an everyday investor. Welcome back to Wyndham Stone, where we make finance simple. As always, this video is for educational purposes and is not financial advice. Now, you might be asking, why $1,000 a month? Because it's a nice round figure? Well, yeah, but that's also $12,000 per year, and that's a level of passive income that could cover a mortgage, rent, or other major expenses for many people. But to generate $12,000 a year in dividends, you need a substantial investment working for you. How substantial? Let's do a quick reality check with the dividend yield, which is the percentage of your investment paid back in dividends each year. If your portfolio yields around 4%, which is a decent yield for solid dividend stocks, you'd need roughly $300,000 invested to get $12,000 a year. If you aim higher for a yield of 6%, you might only need $200,000 invested to net that same $12,000 annually. Higher yield equals less capital needed in theory. Most blue chip dividend stocks, like the famous Dividend aristocrats, actually yield 2 to 3% on average. In early 2025, the median yield of the Dividend aristocrats is about 2.25%. The S&P 500 as a whole has been even lower, around 1.3%. At a 2% yield, you'd need a whopping $600,000 invested for that $12,000 a year, which is why that path can be so slow. So the challenge is clear. $1,000 a month in dividend typically requires hundreds of thousands of dollars invested. For an average person building that from scratch, it is a big mountain to climb, but don't be discouraged. We're going to talk about speeding up the climb. The key trade-off is a high yield versus a slow but still growing yield. One gets you faster with less money, but can be risky. The other one is safer, but needs more money or more time. Let's explore both options. Chapter 2. High yield route. Faster income, but higher risk. This is the fast track path. Focus on investments that pay above average dividend yields. The appeal is obvious. More income now means you hit $1,000 a month with a smaller portfolio. For example, if you could find an investment yielding 8% every $100, your investment pays $8 a year. Compare that to a 3% yielder, which only pays $3 per 100. The difference is clear. High yield can accelerate your income goals dramatically. Let's look at some real-world high yield examples. The first company we're going to look at is ARCC. A business development company that yields roughly 9% a year as of 2025. Invest $20,000 into ARCC and you could get around $1,800 a year in dividends, which averages out to about $150 a month. That's a hefty payout for the amount invested. Verizon, a telecom giant, offers a dividend yield exceeding 6% in 2025. It's a more established company. $20,000 in Verizon would fetch $1,200 a year annually. Verizon's stock price hasn't grown much lately, but it pays generous income in dividends. AT&T, who's also Verizon's rival, historically had a high yield too. Cautionary tale though, AT&T yielded over 6% but cut its dividends nearly in half in 2022. Today, it yields around 5 to 6%. This shows one risk of the high yield route. If a company's payout isn't sustainable, your income can suddenly drop. There's also high yield ETFs/funds. If you'd rather not pick an individual stock, these are ETFs focused on high dividends. These are ETFs such as JEPI, which is a popular one that uses an option strategy to generate income. It yields roughly 7 to 8% as of 2025, and it pays monthly. Another example, QYLD, which yields around 11 to 12%, which is very high. These funds give you diversification and high payouts, but be aware, some high yield ETFs achieve those yields by sacrificing growth. For instance, QYLD strategy can lead to flat or falling share prices over time. Let's look at some pros and cons of the high yield path. Here are some pros. You reach that $1,000 a month target with a lot less invested principal. As we said, at 8% yield, you need $150,000 versus $400,000 at 3%, and that's a game changer for speed. You start seeing significant cash flow sooner, and it feels rewarding to see big dividends pay deposits early on, which can be more motivating. But here are the cons. Dividends could be cut short or even have suspensions. The higher the yield is often the higher the risk. Companies might be in distress or have unstable earnings. We saw AT&T slash its dividends, and many high-yield REITs cut dividends during tough times like the 2020 COVID crash. If you rely on one or two high-yield stocks and they cut their dividends, your income goal is set back suddenly and quickly. Diversification is key. It's wise to hold a basket of 20 to 30 different dividend payers across sectors so one doesn't wreck your plan and blow up in your face. Many of these high yielder stocks also have low stock price growth. Some even decline over time. That means your portfolio might not appreciate much, or even could shrink while paying you. You might get the income, but you're not gaining much capital. In short, the high yield route can be the fastest to $1,000 a month because it requires the least amount of capital. However, you have to manage the risks carefully. Spread the bets. Don't put all your money in one ultra high yielder, and research whether the dividend is stable. The route is like the quote unquote sports car. It's faster, but needs skill and caution to avoid a crash. Chapter 3. Conservative dividend growth route. Slow and steady. Now, for the steady path, focus on high quality dividend growth stocks or broad market dividend funds. These are companies that might not pay a huge yield today, but they grow their dividends over time and tend to have stable or growing stock prices. Think of this as a reliable sedan. It's not as flashy or fast, but it gets you there safely and eventually can go just as far. And what do we mean by dividend growth? Well, companies like Johnson & Johnson or Procter & Gamble have increased their dividends for decades. Coca-Cola raised its dividend for 63 consecutive years as of 2025. These are often called dividend aristocrats. These usually yield in the 2 to 4% range. For example, Coca-Cola's current dividend yield is about 2.8%, and Johnson & Johnson's is about 3%. Not high at face value, but very reliable. More importantly, their payouts grow each year. A 3% yield that grows 5 to 7% per year can outpace a flat 6% yield after enough time. Let's look at some real-world examples here. The first one that comes to mind is dividend ETFs. If picking individual stocks isn't your thing, you're not alone, and you could buy ETFs that hold many dividend payers. For example, the Schwab US Dividend Equity, also known as ticker symbol SCHD, is a very popular one. It yields about 4% a year as of 2025, and it focuses on quality US companies with strong dividends. The VYM, also known as Vanguard High Dividend Yield ETF, yields around 3% and holds large US value companies. These give you diversification and reasonable yield with growth potential. They won't shoot the lights out with yield, but they're stable. Another example is blue chip stocks. Companies like Johnson & Johnson, Procter & Gamble, PepsiCo, McDonald's, Microsoft. Yes, tech companies like Microsoft now pay dividends and they grow. Their yields range anywhere from 1% to 3%, but they tend to increase them every year as their stock price rises over time. For example, Microsoft's yield is only 1%, but it's been growing steadily and its payout by double-digit percentages annually. PepsiCo yields around 2.5%, but has decades of growth and dividends. Let's look at some pros of the conservative dividend growth path. The first one that sticks out is reliability. These companies are less likely to cut their dividends, and in fact, many have never cut their dividends in modern history. During crises, they tend to keep paying or even raising dividends. The second is just naturally growing your income. Your dividend income can grow each year without buying more shares. This helps fight inflation. If you could start at $500 a month in dividends, a good dividend growth portfolio might naturally grow you to $600 or even $700 a month over the years as companies raise payouts. The third is capital appreciation. Typically, these stocks increase in value over time. So not only do you get dividends, but your principal in the stock itself grows. When you eventually retire or need funds, you can sell some stocks that have gained value. High yield stocks often lack this upside. The cons are obvious. It's obviously slower to reach $1,000 a month, and you must have patience. So, in summary, the conservative route is slower initially, but very powerful in the long run. It's about building a sustainable, growing income stream. Chapter 4. Realistic scenarios. How long does it actually take to get to $1,000 a month? Now, let's get practical with the timelines. How quickly can the average person making, say, $50,000 a year and investing a few $100 a month reach our magic number of $1,000 a month? Let's run two scenarios side by side. One using the high yield path and one using the conservative path. We'll assume you reinvest all your dividends along the way, which helps accelerate growth, and we'll use some reasonable estimates for returns. Scenario A, fast track, or also known as high yield. You invest $300 per month, about $3,600 a year, which is roughly 7% of a $50,000 income, into a mix of high-yielding dividend stocks, returning at about 8% annual return. How long does that portfolio take to reach $12,000 a year? It's on the order of 20 years, give or take, with compounding roughly 18 to 20 years of consistent investing could get you up to $150,000 saved up and yielding $1,000 a month. And let's say that you bump that initial investment up to $500 a month. This would accelerate your growth to only 14 to 15 years. On the flip side, if you only manage $100 a month, it might take over 30 years. The more you can invest, the faster it goes, high yield or not. The key takeaway: high yield significantly cuts the required money, but you still need time and consistency to accumulate the principal, unless you have a lump sum to start. Scenario B, slow and steady dividend growth. You invest the same $300 per month, but in a portfolio averaging 8% total return with only 3% yield. Naturally, because each dollar invested yields less immediate income, you need a larger nest egg to get $12,000 a year at a 3% yield. That number turns out to be roughly $400,000. So how long to grow $400,000, which is about $3.6K a year in contributions and 8% growth? That turns out to be roughly 30 years of regular investing. At $500 a month, it might take 24 years. At $100 a month, it could be 40 years. It's a longer journey. But the good news, by the time you get there, your $400,000 portfolio might continue to grow beyond its income of just $12,000 a year because of all those dividend hikes. And your $400,000 principal likely grew from the contributions plus reinvested gains. These timelines are rough estimates, but they paint the bigger picture here. High yield strategies can potentially get you there a decade sooner than low yield strategies for the same monthly contribution because you don't have to accumulate as much as a larger portfolio does. However, and this is crucial, that's assuming everything goes right. If a high yield investment blows up, or you have to cut back contributions during tough times, it can take the longer. Conversely, if you're diligently increasing your contributions over time, say as you get raises or side hustle income, you could speed up both plans. I want to add a bonus part in here because I believe anyone watching this video can truly increase their income over time. So let's add a aspirational upside in here because most people's incomes realistically grow from their 20s into their 30s and so on. So let's say you can only spare $200 a month now, but in a few years you bump it up to $500 and later on $1,000 as your salary improves. This dramatically accelerates the timeline. For example, maybe in your 20s you invest modestly, but by 40s you're investing heavily. You could potentially reach the $1,000 month mark much faster. One rough scenario for you guys is this: 5 years at $200 a month. The next 5 years at $500 a month, then $1,000 a month thereafter. Using a high yield 8% approach, you could hit the goal in around 15 to 18 years total. With a conservative approach, perhaps even 22 to 25 years. The exact numbers will vary, but the lesson is if you increase your contributions as you earn more, your quote dividend snowball grows way faster. The fastest way to $1,000 a month is ultimately to invest as much as you can as early as you can, while balancing yield and risk. Before we wrap it up, it's worth noting you don't have to wait until you fully hit $1,000 to enjoy the benefits. Even an extra $100 to $500 a month from dividends along the way is great. You could celebrate those milestones, $100, $500, etc. It's like reaching base camps on your way up to the mountain. Conclusion and key takeaway. Reaching $1,000 a month in dividend income is a marathon, and it's definitely not a sprint, but there are ways to speed it up. The fastest route for an average investor is to leverage high yield investments, but carefully, so you need less total capital while steadily contributing and reinvesting dividends. At the same time, you shouldn't neglect quality dividend growers that will sustain and boost your income in the long run. And practice a hybrid approach often makes sense. Remember, no matter what path you lean toward, the fuel for this journey is your regular contributions. Even $100 to $500 a month invested consistently, compounding over years, will move you toward that goal. If you can increase your savings rate over time, that's your turbo boost. We hope this breakdown helped make the path to $1,000 per month in dividends clear. Whether you choose the high yield route, the slow and steady route, or a mix of both, stay consistent and stay informed. Over time, you'll watch those dividend payments snowball. Thanks for watching, and let us know in the comments what strategy you prefer or if you have any questions. Don't forget to like and subscribe to Wyndham Stone for more insights. And until next time, happy investing.